Welcome. This is question 3 of the Chrp November 2023 paper. We'll start with the first part. A Dede Toy Shop orders and sells toys at Biashara Street in Nairobi. On January 1st, the shop had 800 units of toys which were purchased at 100 shillings each. During the year, the following purchases were made. So month, 1000 units at 105. May, 1200 units at 110. September, this should be November. November, 1300 units at 120 shillings. September, September 1300 units at 120 shillings. Then November, 1600 units at 122 shillings. The shop sold 4,700 units during the year. Prepare store's ledger card using last in, first out method. And then determine the value of closing stock, 10 marks. Okay, so we'll start with the first one. This is LIFO. They want us to answer this question using LIFO method. LIFO method simply means these are stock or inventory record. These are stock or inventory records, and basically we are following up on the records on the stock availability as at any given point in time. And you can see even part of this question is asking us the value of closing stock. So it's just about following up on the value of the inventory, determining the right value of the inventory. And there are so many ways of determining the value of the inventory. The stocks, inventory is simply the stock that we have at any given point in time. We can use the FIFO method, first in, first out. Whatever came in first, the store will leave out the store first. Or we can use the last in, first out, what the question wants. Whatever came in last, we leave the store first. So we basically release the most current goods from the store. And then we also have NIFO, and all these are methods that can be used to get the value of the stocks in the store. Value of the stock in the store. So we have NIFO. We also have this one, the one that you use the standard price. We have weighted average price, weighted average method. Then we have the simple average method. All this can be used to find the price at which the stocks will leave the store. So it's just a method of valuing or getting to know the value of the goods in the store. And there are so many ways. All these are the different ways that can be used to get the value of the goods in the store. Now, in this particular case, the examiner is interested in LIFO. So we are going to, this store that we are talking about, or rather the Dede Toy Shop, uses the LIFO method. So we'll be able to determine the value of the goods in store using the LIFO method, and that's what the question expects of us. So let's prepare a store's ledger card using last in, first out method. Last in, first out method, I've just said that we are going to release the most current goods from the store. The most current goods from the store. And of course, when we release the most current goods from the store, we are going to use the price at which the said goods, the current goods, were received. This is the price that will be used to release the goods, and it's also the price that will be used to find out the value of the goods, of the remaining goods in the store. Value of the remaining goods in the store, which is what the second part of the question is asking, the value of the closing stock. Okay, so let's go back to the question and answer it. Prepare a store ledger card using LIFO method. Now, Store ledger card will have some components which are very critical. So we'll have, this is how it looks like. Then of course we normally have the date. Then we have the receipts section, receipts, and under the receipts section we have we'll have some columns. Then you have the issuance, and then we'll have the balances. That's how it goes. So under the balance we have the quantity and amount. Then under the issuance we have the quantity, the price per unit that we are going to use, and then the amount. And under the receipts we're also going to have the quantity, then the price per unit, and then the amount. That's basically how a stores ledger looks like. So that's how it looks like. Very simple with all those columns. You just need to understand how they go, and it will be very easy for you. So date, receipts, issuance, balances. So receipts, the store receives goods. Issuance, the store releases the goods, whoever the users are, and then balances whatever remains in the store. And of course the date is when the goods were received or released. So in this particular question, we started with the balance. On January 1st, the shop had 800 units of toys which were purchased at 100 each. So you simply come here and say 1st January, quantity 800 units. Did we receive or they were there? On January 1st, the shop had 800 units of toys which were purchased at 100 each. It's as good as saying 800 units purchased at 100, so the total amount was 80,000. Because this was an issuance, we'll simply come here and bring the balance here, 800 valued at 80,000. So that's how it will be. We have recorded. We have assumed that we received this, of course, from the previous year. We have received 800 pieces at 100 each, totaling, if we multiply the two, get 80,000. We've not issued. So at the end of the day, we'll have our quantity. It will be the same quantity that we had here, and amount the same amount that we had here. Then now we need to be very keen on when the goods were sold, were issued. Now the shop sold 4,700 units there. Okay, this question has not given us the period within which these goods were sold. So that's a bit normally we expect them to show us a good store should be receiving goods and also issuing. So for this one, we've just been told that the shop issued or sold 4,700 units during the year, but they have not told us the specific time. So it might be quite challenging for us to know when to have this. But anyway, let's go with what is available for us, and then we'll see how to go about that. So the month of February, the store received 1,000 units. So you simply come back here and you show February. Because there's no date, you can as well just say February. And I think there's a column here which is very important that I'm almost forgetting. So for the sake of it, let's just have it. This is a very important column called particulars. Let's have a column here that we will call particulars. And then of course we continue with, we have the date column here. It is very important, so that here we have 1 as we had already indicated. Then the particulars will just say balance brought forward from the previous year. And then February, we'll say these are, what are these? Purchases. I think that's the word they are using. Purchases. So we'll talk of purchases in February. It's very important that we narrate at least what is happening. So purchases. How many goods were purchased? 1,000 worth of 1,000 units at 105 shillings. So 1,000 at 105. This gives us 105,000. So by the end of this February, the goods that were in store were 800, which were there previously, plus 1,000, which were the additional 1,000. So that gives us 1,800 goods. And then initially the 800 were valued at 80,000. And now with the receipt of the 1,000 goods valued at 105,000, the total value of the goods available in the store will now be 80,000 plus 105,000. We had goods worth 80,000, we've received goods worth 105,000. So the total value becomes 185,000. We've simply added 80 plus 105 to get that. 800 plus to get that. Then in March, we again received more goods. Not March, sorry, this is May. In May, we received more goods, 1,200 goods at 110 each. So simply multiply 1,200 times 110. 1,200 times 110. That gives us 132,000. So it means the value of the goods we received was 132,000. So this is purchases. In May, we received 1,200 units at 110 per unit. So if we multiply, we get 132,000. How many goods did you have in the store before receipt of this? 1,800. How many goods have we received now? 1,200. So total goods we have in the store, 1,800 plus 1,200, which gives us 3,000. What was the value of the 1,800 units? 185,000. What is the value of the 1,200 units that have just been received? 132,000. So 185,000 plus 132,000, we have, that is 317,000 if I'm not wrong. 317,000. So that is the current value of goods that are in the store. And these are the number of units of those goods that are in the store. So you can see we have a progress. We are checking on the inventory of the goods that we have in the store as at any given point in time. So after that, we go to September. September purchases. How many goods did we purchase? 1,300. At how much? 120 each. So 1,200, 300 times 120. 1,300 times 120. This gives us 156,000. So 156,000. So then, initially we had 3,000 units in the store. We've added 1,300. So how many units do you have? 4,300. They were valued at 317,000 initially. The new goods that we've just brought in, 156,000. So 317 plus 156,000, that is 473. 473,000. That is the value of the goods as at that particular point in time. So let's go to November. In November, we received again another set of goods purchases, 1,600 pieces at 122 each. So how much does that come to? 1,600 times 122. 1,600 times 122. This gives us 195,200. 195,200. So 4,300 plus 16. This gives us 5,900 units that we have. And then 473,000 plus 195,200. That one gives us how much? Plus 473,000. That one gives us 668,200. 668,200. So that's how it is. 668,200. Those are the goods we had. And so we've received all the goods. The shop sold 4,700 units during the year. So we can assume that because they have not given us any time, the duration, let's now release the 4,700 goods. If they had given us, it would have been better. But since then they did not give us, let's now take this opportunity to release all the 4,700 units. So let's assume we are releasing them the same November or December. So November sales, how many units are we selling? 4,700. 4,700 units. Yeah, those are the goods that we are releasing. But now this is where the catch comes in. The goods are normally released, will be released using the LIFO method. The goods will be released using the LIFO method. So the last in, first out. So in this case, the last batch was this one, the one that was received in November. So last batch, how many units did we get? 1,600 worth of units. 1,600. At what cost did we receive them? 122. So we are releasing the first batch first before we can, like that. I think that was our definition. We release the most current batch. So we will start with this one, the November one. That is the most current. But the November one was received at 122 shillings per unit. So we can only release the November batch at the amount at which they were received with. So in this case, 1,600 at 122. How much will that be? We have the figure there, 195,000. So 195,000. That's how we go about it. So we'll release these goods first. So if we release 59 minus 1,600, what do we have? 4,300. Then 668,000 minus 195,000, it's 473,000. So that's how we go. We've released 1,600 units, so we've remained with 4,300 units, and their value has also decreased from 668,800 to 473,000. Now, out of the 4,700 units, we've only managed to release 1,600. Now, we've of course exhausted this batch. So, what next? We go to the next batch, which is 1,300. How much did we receive that batch at? 120. What is the total? 156,000. So then let's deduct this from this. We had 4,300 minus 1,300, 3,000. Then 473 minus 156, 473 minus 156,000, we will have 317,000. 300. This is 473 minus 156,000 gives us 317,000. So far out of the 4,700 that we are supposed to release, we've only released 2,900 from the two most current batches. Since we've exhausted these two most current batches, we go to the third level, which is now 1,200. So 1,200, and we had received this at 110, so we release them at 110, which will cost the organization 132,000. So then 3,000 minus 12, we have 18. 317,000 minus 132, we have 185,000, like that. Do we still have more goods here? Our target is 4,700. So far, how many goods have we released? 16 plus 19, that is 29. 16 plus 13, that is 29. 29 plus 12, that is 4,100. So we are only in deficit of 600. So this 600 will get them from this batch. So, and this batch, the goods were received at 105, so we'll also release them at 105. So 600 times 105, What do we have? 600 times 105. This gives us 63,000. So 63,000. So 180 minus 600, you have 185,000 minus 63,000, you have 122,000. So that is the end. We have already done everything that we are supposed to do. That simply becomes the end of this journey. We've released the entire 4,700 units, and so this becomes the store ledger card having applied the LIFO method. So that should give you 7 marks. Then the last part 2 of the question, determine the value of closing stock. The value of closing stock is 122,000. That's all, this one. That is the value of the closing stock. So we are done. That is it. We are done. With the part A of that question. So part B of the question will take just a few minutes. Peter and Mary intend to start a business, but they are constrained by capital. Explain the various sources of capital they may consider. Explain the various sources of capital they may consider. They intend to start a business, but they are constrained by capital. Explain the various sources of capital they may consider. So they want to start a business, they don't have capital. So what are the various sources of capital that they might consider? Number 1, leasing. They might consider leasing. Instead of maybe coming up with their own buildings, apartment, they can simply lease. Leasing is using other people's property. Then of course you pay on a monthly basis, or as per the agreement, how you are going to agree. In most cases it's periodically. Most of the businesses will end up agreeing on a monthly basis. Can talk of rent. In most cases we talk of rent, especially when you refer to office space, but leasing might be quite for a little bit longer period of time, say 3 months, half a year or so. So instead of having your own apartment or building or shop, or you can just lease, and that will mean instead of spending like say 5 million to put up your own premise, you can end up paying say 30,000 per month or 90,000 per quarter, and you'll still have access to the same premises and do your business. So leasing, yes, it can be one of the sources they can go for. It's a short-term source of finance. Short-term source of finance. Then we also have credit. Let me just talk of something else. Of course, the most common one is savings. Savings. They can go for savings. They can go for overdraft facilities. Overdraft facility. This is from the banks. And this will apply if they have security. So if they have security, they can always go to the bank and, trade in with the security. Give them the security, they get the cash, which will allow them to do the business. Then we also have credit purchases. Credit purchases, very common. Instead of say buying goods in cash, they can enter into agreements and buy the goods on credit. Credit means that they will be able to have the goods, but they will pay for them at a later date. Or they can get the goods, sell them, get the cash, and then pay their creditors later on. So you can simply talk of credit purchases. The other source of finance that is available to these people are the venture capitalists. Venture capitalists. And this applies when they have a very good idea. A very good idea. They can sell the idea to the capitalists. People have money, and of course these people can come in, and depending with how they are going to agree, they can pump in the monies, and of course later on share the profits at their agreed ratios. So venture capitalists, these are people who have the capital, but they may not be having the idea. So if you have a very good idea, you can sell the idea to them, and then of course they will come in and support you to the extent of the requirements of the business, and after which of course you will settle down according to how you will have agreed. Okay, then we also have the debentures. Debentures. These are long-term loans. Long-term loans. They can enter into agreements with the banks for debentures for long-term loans. And in most cases, that will require security. So if they have securities like land or something, they can use that as a collateral for them to acquire the loans, long-term loans from the banks or any other financial institution at that. Use that money to do business, and then of course pay later. You also have others like accruals. Accruals. This is where they can possibly delay the payments. Delay the payments. So of course, when you do business, you will have you will incur a lot of expenses. So instead of paying these expenses at their right time, you delay the payments a little bit, and then the amount can be used to, as a source of funds, as a source of finance. So you can use that money to, say, buy stock, sell it before you can now raise again the money from the sales to pay these people now. Doing that simply means that you'll have raised some extra source of capital from the expenses which you are supposed to have met well in advance. For example, if you normally pay rent on the 5th of every month, you can delay this by, say, 5 days to pay the rent by 10th of the same month. So within these 5 days, you will have acquired a new source of finance, because you'll be having this money for 5 days just to do your errands before you can now pay the landlord. But to make sure that this doesn't cause bad blood between you and the recipient of the monies. Okay. We also have the factoring. Factoring, we have the bill financing or invoice financing. This is very common when you have the LPO. Sometimes some of these businesses, like the tenders, you get the LPO, you apply, you don't have the money, you apply for the tender. If it goes successful, you will be given the LPO. LPO is local purchase order, or LSO, local sales order. So once you have that document, you can walk into any financial institution and use it as a collateral for a credit facility. So we call it bill financing or invoice financing, or the invoice discounting. All those terms will come in handy, where you simply use the LPO to access a credit facility. And then of course, an LPO means that you've already been given the job, so you just need to perform the job and the money will be paid to you, but through that financial institution that will have advanced a credit facility to you. So that's how it goes. That is called bill. You can talk of bill financing, or we can talk of invoice discounting. always discounting, or yeah, all of them are terms that can be used for that particular source of capital. So I think we can work with this, though there are quite a number. Let's work with this. Even mortgages. Mortgages are also a source of finance. Mortgages. And this is basically from, in most cases, from financial institutions, and they're used to finance long-term loans. So if your business is real estate, you can simply go for a mortgage. And a mortgage simply means that the same asset that you want to purchase or invest in will be the security for that particular loan, as opposed to like some things like debentures. For debenture, you might have to have collateral, which is totally different from where you're going to put your money in. But for a mortgage, where you are going to put your money in, that is the same asset that will act as a collateral. So in case of failure to meet your obligation, the asset that actually consumed the money will be attached, and the financial institution use it to recover its monies back. These are quite a number. The examiner only wants 5, so you might just want to pick any 5 from this, and you'll be good to go. Thank you. Let's meet in the next question.